Hello, everyone. This is Lance Mullen, host of the MSU podcast. Today we have special guest CEO of Capital Market Consultants, Barry Mendelson. In this episode, Barry and I discuss his role as CEO, investment techniques, and how capital market consultants serve their clients. Enjoy. Welcome back, everyone, to the MSU WMA podcast. Today, we have a special guest. I'm happy to introduce CEO of Capital Market Consultants, Barry Mendelson. Barry, thanks for joining us.
Pleasure. My wife is an alumnus of the school.
Yeah, go green. So just want to jump right into it. Do you want to tell us a little bit about yourself, kind of where you are today and how you got there?
Sure, I'd be happy to do that. I've been in the financial services business for about 40 years. I started off as my first 10 years, I was an advisor working with individual families. And then I found that the part of financial planning and wealth management that I liked the most was the investment management, the ongoing investment management part. And so I went back to school and got a special designation through the Wharton School and have used that to essentially be a launching pad for the rest of my career. I spent the next 10 years from about 1990 to 2000 working inside of larger firms, either developing or running and developing investment management programs for the firm that I worked for's advisors. The firm that I worked for that had the largest universe of advisors spread out across the country in branch offices was a company by the name of RW Baird. And they had at the time, I think at the time, the peak number was something around 900 advisors around the country, and probably, I don't know, maybe 100 offices in different parts of the country. And I worked in the Milwaukee headquarters and I ran the investment management business. And we had a team of about 30 people that supported those 900 advisors. And then I realized along the way, this was now actually when I was living in Detroit, because I worked at a firm called First of Michigan for a little while until it was acquired. And then along the way, I decided that the things that I was doing inside of these larger firms sort of had some legs, and there was a growing marketplace for wealth management investment services. I know it seems like it is a long time ago, but in the mid 1990s, in the early 1990s, there was nothing like that around. The investment environment you see today that existed back then was very, very different from what it is today. And so the kind of world we live in today couldn't even have been imagined in the early 1990s. But I started, along with a lot of other people, we started seeing that this was going to happen. And so I started my firm that I'm in right now, Capital Market Consultants, in 2002 with the ideas that I generated while I was living in Detroit. And that was to provide these investment management support services for any firm, for any advisor, anywhere in the country. It didn't have to be a firm like a Baird or Northwestern Mutual or a Merrill Lynch. It was all these independent advisors and accountants and lawyers and lots of different people who were getting into the wealth management business. And they didn't have the kind of support mechanisms that the advisors who worked for Robert W. Baird enjoyed. And so I was sort of the surrogate department for them. And that's what my firm has been doing for 20 years.
That's awesome. So you mentioned you kind of work with advisors kind of on the side. Do you want to kind of go a little more in depth of what you do at Capital Markets?
Sure, I'd be happy to do that. Let me back up for a second and say we have clients from coast to coast. We have clients that are registered investment advisors. And most of the time, those registered investment advisors are certified financial planners. We have community banks that are clients of ours, trust departments of community banks, multifamily offices, which are essentially investment advisory firms for very wealthy families. We have accounting firms that are clients. We have law firms that are clients, and all of these firms, all of these types of firms, wherever they are in the country, all of them are in the wealth management business in one way, shape, form, or another. And they may have their own resources. They may not have any resources. And the firms that have less resources rely on us for more things. And the firms that have a lot of resources, we're usually sort of filling in the blanks or doing things they can't quite do or they don't have the bandwidth to do. And the things that we do are essentially, think of us as a research department, an investment research department. And we do everything from portfolio construction to investment product selection, mutual funds, ETFs, separate accounts, hedge funds, liquid alternatives. We do asset allocation to combine these strategies into portfolios that advisors can use with their clients. We develop newsletters that they can send to their clients about the economy, about the markets, about their portfolios, all kinds of collateral material, all kinds of updates on the economy. The economist at our firm is the former head of the economics department at Marquette University and was essentially the lead economist, not the head economist, but the lead economist at the United Nations for 5 years. So it's a firm that specializes in investment management support services and economic research.
Okay, yeah, that's awesome. There's a lot going on, it seems like. Um, and you're obviously kind of the creator, and like I said, you're the CEO. What does that kind of look like on your day to day, on your half of what you do? How much do you have to do each day?
Well, I'm by my sort of constitution and my nature, I'm sort of a blue collar guy. So I have a full day of work. I minimize as much as I can any management that I have to do because
Yeah,
it's not nearly as enjoyable as working with advisors and working with banks and working with people and solving problems and applying the knowledge and the technology that we have to create solutions for different organizations around the United States. So for me, my day starts with sort of touring the world news, and I spend about an hour reading articles and reading about Europe, reading what's going on, what happened in Japan, reading about what's going on in the market, taking a look at the futures market, and sort of getting a pulse on the day. By our nature, we're not traders. We're not active traders. We're long-term strategic in our thinking, but it is important to understand the influences that are impacting the market and how the market is behaving, because our advisors are being impacted by their retail customers, their consumers who can vary from being complacent and euphoric about how well their portfolios are doing to be scared out of their mind and wanting it, to get to
yeah,
100% cash and sell everything. And so we sort of holding the hands of the advisors and educating them so that they feel comfortable and they aren't apprehensive about talking to their clients. So my day
yeah,
is filled with developing reports, interpreting reports, writing reports, looking at news, writing newsletters, doing presentations, providing client service, talking to clients, doing speeches. Every day is different. Every day is exciting. So no 2 days are the same.
yeah. It seems like you wear quite a few different hats and always have a different day. What are some of the
Yes.
main responsibilities that you have, though?
Well, from an administrative standpoint, I have responsibility for everything from, and by the way, I will say in a small firm like ours with 4 people, we outsource a lot of things to other professionals. Not the investment part, not the analysis, but we outsource all of our invoicing and accounting and tax work to an accounting firm. We have a law firm that we work with that does any of our legal work we do, regulatory filings with the government, things like that. We have a tech firm that monitors our that has built and monitors our cloud-based platform, which is nice because any of us can work anywhere in the world. Doesn't matter where we are, and it's as if we're sitting at our desk in Milwaukee. We have an investment committee meeting every week at 1:00 Central, and we really sort of go over our firm, what's going on with our clients, what's going on with our portfolios that we've been building for clients, what research efforts we are doing. We talk about how our portfolios have done. We look at the returns. We look at the performance attribution. We look at what the economy is doing. We look at valuations. We look at what's going on politically. We look at what's going on economically. We look at generally the market and the economy as a whole, and how we think it's going to impact the market, and what, if any, suggestions we may need to suggest to our clients in terms of product selection or portfolio asset allocation tilting, given where we think the economy and where the markets are headed. So we want to try to get ahead of that instead of waiting for it to happen.
Yeah, you've mentioned how a lot of things in the world they kind of correlate to what's going on in the market. And I kind of want to ask you, how does the business change when you have a up market or down market? What does that look like with your business, and kind of how do you adapt to that?
It's interesting. For our business, I wish there were I had a clear answer for you. And I wish I had an answer that said, when the market's up, these are the kinds of clients we have, and these are the kinds of things clients are asking for. And when we have a bear market, here are the kinds of things. But in general, I would say, from a behavioral finance point of view, when the market's doing very well, people, including advisors, tend to get complacent because the market is doing all the work. They're not doing any of it.
Yeah.
And so it's easy to forget all the work that you have to do to keep looking forward and looking for potholes and looking for speed bumps and bad things that could happen that could derail the market. I remember having conversations with clients when this is now in 2017 and 18, when what we call the mega cap growth stocks, Nvidia, Amazon, Apple, Microsoft, those big tech giants were dominating the market. This is now, and this was also going into the pandemic in 2020. Yeah. This also happened. You would look at the valuations, the PE ratio of these companies, PE ratios as an example, and you'd say, these PEs don't make any sense. These growth valuations make absolutely no sense. I remember having a conversation with a client, and we were talking about Nvidia. We were talking about Netflix. And I said to them, because we were suggesting to clients that they start paring back their growth exposure. So sell into the rally and start building your value position in conservative dividend paying stocks, because that's going to pay off down the road. You can't see it now, but you will appreciate it somewhere down the road. Yeah. And I remember having a conversation with a client, and I said to him, does it really make sense to you to be buying Netflix when the price earnings multiple is 270 times earnings? Yeah. Yeah. And but no one was giving any thought to that. These P ratios were absolutely nuts. And anybody who's got, like I have had, lots of different experiences over 40 years, multiple market cycles. I was here for the '87 crash. When I started in the market, the Dow was 700. Yeah, now it's 33,000. Yeah. And so I've been through crashes, I've been through currencies, I've been through the .com, I've been through Y2K, I've been through the market crash, I've been through the pandemic. And after you've been through this 3 or 4 times, it doesn't bother you as much, because you know we're going to come out on the other end of this. And so you use your experience to try to understand and navigate. And so we have to do that for ourselves as a firm, and then we have to try to articulate that for our advisor clients to help them feel comfortable and for them to be able to communicate that in simple talking points to make their clients feel comfortable. And sometimes we're actually asked to do radio shows, or we do client events and we do speeches to help their clients feel comfortable.
Yeah, I've definitely heard that a lot, and I think that that experience of being part of some of those down markets and knowing how it ended up can kind of help you ease some of those clients. And
Yeah.
I think that's a huge part.
Yeah. Now I talked about a bull market. People get complacent, but on the other hand, when the market's going down and you've got a lot of downside volatility, what people don't often, what a lot of advisors that don't have, let's just say, the depth of experience or training that full-time investment professionals have, they don't realize that when the market's going down, as an investor, as a professional investor, your idea pipeline is swelling because the
Yeah,
prices are going down and the valuations are looking more attractive. And
yeah, you
so
kind of get
down
a
markets are very, you have to have these down markets to get those opportunities to buy securities at prices that are really attractive. It's hard to buy stocks, as anyone who looks at valuation as a consideration when you're purchasing an asset. It's hard to buy those when you have PE multiples of 270 times
yeah,
earnings. I can't tell you how many times even growth managers that I tell you how many investment managers I've talked to that never had a full weighting in Apple. And the reason why they never had full weighting in Apple was actually not because the PE ratio was so high, but it was because of the weight of the weight of Apple in the S&P 500. It was, I think, upwards at one point. It was almost 9%, or maybe it was in the growth of the Russell 1000 growth index. And these managers have to be diversified. They can't own Apple at 9%. They can own it at maybe 4% or 5%. So when Apple was dominating the market and it was running like crazy, these guys could not keep up with the growth index because they didn't have a full weight in Apple. They couldn't, because they're required to have diversification. The S&P 500 or the Russell 1000 growth index has no such diversification requirements. So when we as an analyst are evaluating investment managers or mutual funds, things like that, investment guidelines that managers hold themselves to, are very important considerations when evaluating whether they did well or not. What set
yeah,
of rules are they operating by? If they're operating by a more lax set of rules, then maybe they did really well, maybe they did poorly. But if they did in sort of absolute terms, if you just looked at the numbers and you say, well, gee, they underperformed the benchmark by a lot. Well, yeah, and oftentimes they're taking half the risk.
yeah,
So they're getting 75% of the return with half the risk. So all returns that managers generate and ETFs that are generated have to be seen through the lens of how much risk they're taking, number one, and what investment guidelines, what rules of the road are they following to run a portfolio.
yeah. And I know you touched on a little bit of kind of like the valuation of stocks that you guys look at, kind of the PE ratio. And I know we have a lot of students and maybe some listeners that might not know a ton about stock valuation. So do you want to kind of touch a little bit on how you guys value stocks, or kind of how you evaluate some risk?
Let's see here. Well, I'm assuming everyone knows what a price earnings multiple is. If not, it's the price of the stock divided by the earnings of the company. The PE ratio on the S&P 500 historically has been plus or minus 50 basis points of 16 times earnings. So the price of the S&P 500 is about 16 times the aggregate earnings of the S&P 500 stocks earnings. Growth stocks, the growth stocks in the riskier stocks, the more volatile stocks in the S&P 500 have a historical PE ratios that's significantly higher. I don't remember exactly what it is, but maybe 20 or 25 times, 20, 22, 23 times earnings. And
Yeah,
value stocks would be maybe 10 to 12 times earnings. So the value stocks are more conservative. They're less volatile. They oftentimes have dividends. And they tend to be more to a certain kind of way, the steady Eddie type stocks, not flashy, not sexy, they're not going to hit the ball out of the park, but they're going to give you a respectable turn. The large cap growth stocks are the ones where you can hit home runs, really hit home runs, but you can also lose big too.
Yeah,
So
there's a little bit more risk involved with those.
Right. So we're looking, when we're looking at stocks, again, we're not evaluating individual stocks, but when we're looking at P ratios at different subcomponents or components of the equity markets, what we're looking for is where is it in relationship to the overall market, the 16 times earnings or whatever it is. I think the S&P 500 at the end of last week was 18.1 times earnings. We'll get back to that in a few minutes. A year ago, the S&P 500 P ratio was well over 20. So we would say in our profession, the valuations were stretched. They're not as stretched now, but they were more stretched a year ago. And what we'd like to take a look at is, where is today's valuation in terms of PE relative to history? Where is it in relationship to its highest high and its lowest low? Number two, number three, we like to take a look at PE ratios in relationship to the economic cycle. How do they change with the economic cycle? We also like to take a look at PE ratios in a sector. So our technology stocks as a group of stocks, are they priced at the high end of the valuation, their historical valuation range, or at the low end? So we're trying to take a look at the 10 sectors or so in the S&P 500 and see if the S&P 500 is stretched, the 18.1 right now. You might ask yourself, well, why? I mean, we're in a recession. Stocks were down early in the year. Why is that? Why is that? Well, that's because the large stocks, the large mega cap growth stocks, are running again. They're doing really well, and they comprise a disproportionate share of the weighted capitalization of the S&P 500. So they have a dominant influence, and that's why the P ratio is at 18 times earnings. But the rest of the market is not doing anywhere near as well and is much more attractively priced. So the point I was going to make earlier, the point I mentioned earlier was, it looks to us like we're probably going or heading into some kind of a recession in the next 12 months, maybe inside the next 6 months. In the fourth quarter of 2022, we had what we call an earnings growth recession, which means that the earnings growth of the S&P 500 companies was less in the fourth quarter of 22 than it was in the fourth quarter of 2021. And the forecast for the first quarter of 23 is a minus 6% earnings growth rate compared to the first quarter of 2022. And as we go farther into this recession and interest rates stay higher for longer, you should reasonably expect that that's going to continue through the course of the year. And at some point, if stock prices don't come down as earnings are going down, what's going to happen to the PE ratio? It's going to start creeping up again. And it's going to go above 18 and into 19 and 20 because the earnings are going backwards, but the price is being stable or maybe going up a little bit. So we would tend to think something has got to give along those lines, and stock prices will have to pull back.
Yeah.
So this would be a time to be looking to sort of marshal your resources, have a little cash on the sidelines so that you could reinvest it at cheaper prices somewhere down the road. But as I have learned, especially over the last 15 years in my career, being a professional investor not only includes having a clear idea about what you want to do and what you want to accomplish, and have a clear-eyed view about what you think the market environment and economic environment is going to look like, but you have to have the patience to wait to get there, to do things. You can't just invent every day. You have to wait for, it's a little bit like the movie Top Gun. You know, have you seen the movie Top Gun? You know, when he locks on that plane and then he hits the button and shoots it. You got to wait for that. You got to wait to lock on to the situation, and then you can pull the trigger. And sometimes, as an example, we've been sitting with in our portfolios that we've recommended to our clients, we've been sitting with 10% in cash for a year. And in 2022, that was the smartest thing we could have done.
Mm-hmm.
In 2023, it hasn't worked so well, and we're waiting for the market to pull back again. And when it does, we have cash. We're ready to go.
Yeah. So when you're advising clients, how do you, if a client maybe doesn't agree fully with that, how do you kind of deal with that and kind of show them what your research is on certain stocks or your portfolios
Yep.
compared to what their ideas are?
Really good question. And there are actually two answers to that. The first one, and frankly the most important one, is we never force a client to do what we think they should do. If they want to do things a little bit differently, that's perfectly fine with us. Let us know what you're going to do, and we'll run the analytics on your portfolios for you. They don't have to be our portfolios. They can be your variety, your variation, your differentiation. That's perfectly okay with us. So that's number one. We're not asking anybody to do anything. We'd like to think of ourselves as a reference point, as sort of a clear thinking way of looking at what's going on economically, what's going on in the market. And based upon that analysis, here's what we would do. You can say, well, I would prefer doing it a different way. That's fine with us. But what we do is we have a meeting with most of our clients every single month. And we go through a presentation where we present the pros and cons of what's going on in the economy and what's going on, pros and cons for what's going on in the market. And we say the implications of all of this are the following of portfolio construction.
Yeah. So with kind of with those clients, are those mostly advisors or are those mostly individuals that advisors are working with?
No, it's all advisors. We as a firm never work with individuals because our clients are advisors, and we would never want to compete with our advisors for a customer.
Okay.
So we restrict having any individual investors. Our only clients are wealth managers, advisors. They work at banks. They have their own financial planning firm. Those are our clients. They work with the individual investors.
Do you have any advice for any advisors kind of listening or any students when it comes to investing or kind of getting started with your career?
I would say general advice would be, if you've never read the book, The 7 Habits of Highly Successful People, I suggest you do that. One of the 7 habits which I have tried to follow, and I found it to be very valuable, he sums up in a sentence, which is measure twice and cut once.
Mm-hmm.
Measure as often as you like, analyze as often as you like, but really think about things before you do it. And make sure you are in your own mind as right as possible. That applies to your career. That applies to investing. Frankly, that applies to a lot of things in life. So that's the first thing I would say. I would say also that the wealth management business is a very diverse business, and there are many ways many jobs, many roles you could conceivably be attracted to, where you could make a nice living and make a contribution to people's lives. You could be a planner. You could be an analyst. You could be a securities analyst. You could be a portfolio manager. You could work in the back office of a big brokerage firm or a bank. There are many things you could do which are satisfying. There's no one way. There's no one job. I will say, as I mentioned earlier, going back 25, 30, 40 years, the financial business was very different back then. And the people who were at the top of the totem pole way back then, from a political point of view, were the portfolio managers, the investment managers, and the analysts that work for them. But as the ETF industry has proliferated, and active management versus passive management has been more of a competition, active managers have been brought down a lot of different pegs, and it's become a contracting and consolidating industry. So working for an investment manager is not necessarily they're not nearly as many jobs as there used to be. They're not nearly as many firms as there used to be. So being a planner, I think, is a really valuable thing, because you've got an entire baby boom generation going to be retiring in the next 10 or 15 years, and they need a lot of help. And so
Yeah.
being a certified financial planner and working, let's say, with a firm like a Capital Market Consultants as a combination makes a lot of sense. You're going to help a lot of people. You're going to solve a lot of problems. Most people most individual households, they may get an education, but they don't know anything about what to do with their money.
Yeah.
They don't know the first thing about what to do with their money. And having a plan and having an approach and having discipline and patience, which is what a certified financial planner who's well trained can bring them, will pay off immeasurably over the course of a lifetime.
Yeah, Barry, that's great advice. It was great having you on. I had the pleasure to have a great conversation with you. I really enjoyed it.
Terrific. I hope something I said provokes someone to do something great someday.
If you like what you just heard, please like, comment, and share. This is Lance Mullen, producer of the MSU WMA podcast. MSU WMA, or Michigan State University Wealth Management Association, is a student organization part of the Eli Broad College of Business, located in East Lansing, Michigan. Our mission is to inspire and educate the next generation of financial planners. Thank you for listening to today's episode. If you enjoyed, please check out our channel on all platforms such as Spotify and Apple Podcasts, and check out our social media at MSUWMA and MSUWMA.com.